I think we saw the Commission of Audit come through, and I think the thing to remember at the moment is that it is recommendations, and we'll get a clearer picture of what the government intends to do at the May budget. Now, this audit report did come through at 2 p.m, and if we have a look at the market, this is 2 p.m. You can see after 2 p.m. we went down to the lows of the session, but the market was already lower. I think in terms of the May budget, you have to look at it in terms of three levels. First, the macro impact, and I guess the government is one of the biggest spenders in the economy. So if we do see spending decreasing at a time when unemployment has been going up and mining investment has been going down, then that could have a negative impact. Secondly, the individual stock impacts. There's a lot of talk on the impact in terms of the healthcare space. We know that in the past the pharmaceutical benefit schemes and the impacts there have had impacts on stocks like Sigma Pharmaceuticals and Australian pharmaceutical industries. But also, if we do see this private health insurance levy going up to 3 times as recommended today, we could see private health insurance like NIB Holdings seeing a benefit there. And also, I guess in terms of competition, just watching that childcare space, G8 Education has been one stock that's been going great throughout the last few years. But of course, if there are childcare rebates offered on nannies, we could see increased competition there. And then lastly and thirdly, asset sales. There has been talk of asset sales, the Mint, Australia Post, Defence Housing, just to name a few. And of course, if we see increased corporate activity there, that's great news for the investment banks. But in terms of the market, usually what we do see is fund managers selling some of their portfolio to make room for some of these very large IPOs that come to the market. So in terms of the May budget, I guess we're looking at it on 3 levels. One's the macro level and the impact on the Australian economy. Secondly is the individual stock impacts. And then thirdly, the asset sales, what that means for the Australian share market overall.
Right, let's get into the graph behind you. That is a dramatic daily chart. Not a good session.
Not a good session at all, and even worse because over in the US we actually saw the Dow reaching record highs. So the Australian market at odds with the overseas market, and I guess the big impact in terms of the Aussie share market is a bit of a tug-of-war between the strength in the US market and then what's happening in China. And it does look like what's happening in China is having a bigger impact in terms of the Aussie market. Now today the Chinese market was closed for the May Day holiday or the Labour holiday over in China. We also saw Singapore closed, Hong Kong, and most of Europe will also be closed as well. But it was a difficult day for the Australian share market, and it's understandable when you see our 2 largest sectors, the materials and the financial space, which make up more than 50% of the ASX, seeing pretty sharp falls. In terms of the materials space, very much impacted by the iron ore price falls that we saw. Iron ore prices tumbling by 2.7% overnight. And in terms of the financial space, well, it was all about ANZ today. And when you see a stock coming in ahead of expectations in terms of its earning result, and the stock down 1.2%, as we saw for ANZ, it certainly doesn't bode well for some of its peers like NAB and Westpac, which will be reporting next week. So we did see NAB being sold down 1.7% and Westpac down by 1.2%. All in all, though, it was a pretty bearish session for the Australian share market. Red across the board, every single sector trading lower. Not only that, we did see the smaller and mid-cap stocks being sold off even more harshly than the blue chips and the larger and the broader index. If we have a look at some of the data points during the session, the China PMI numbers coming in slightly below expectations, a read of 50.4. Expectations were 50.5, but a slight improvement from the month before, and a read of 50.3. So all in all, I think a disappointing day, a tug-of-war between the very bullish environment that we are seeing in terms of the US stock market and the bearish environment that we're seeing in terms of the Chinese market, and unfortunately the Australian market more swayed by what's happening in China.
Just on the iron ore price falls, as you mentioned, that we saw today, and the subsequent reaction among some of our iron ore producers. Fortescue down 4%, Atlas Iron down almost 4.5%, Rio down 1.5%. Look, is it being overdone? Or were these starting to look like good value again, or is there warranted caution around them because of what we're seeing in regards to price?
I think in the short term, you have to say there has to be caution in terms of the iron ore miners and the iron ore price. And really in terms of commodities, we look at it in terms of both supply and in terms of demand. Now, on the demand side of things, unfortunately, we are seeing China clamping down on heavily polluting industries as well as some of those loss-making industries. And one of those key industries is the steel industry. Now, the steel industry, when we have a look at financing deals, some of those financing deals are underpinned by commodities such as iron ore, copper, and even gold. So with tightening monetary conditions, some of the collateral requirements from the banks going up there, we are seeing iron ore prices being sold off quite dramatically, copper prices being sold off dramatically, and a smaller impact in terms of gold prices. Now, on the supply side of things, we know that the iron ore miners are ramping up in the Pilbara region. So the likes of Rio Tinto, Fortescue, really ramping up their iron ore production at a time when we are seeing weaker demand. So unfortunately, that's a negative for those iron ore miners. We did see some big impacts in terms of pricing today. If we have a look at some of those iron ore miners, we saw BC Iron down by 3.7%, Fortescue also falling by around about 4%. Now, China is on holidays at the moment, but I think why we've seen such a dramatic fall overnight is that there has been talk that the PBOC, the People's Bank of China, as well as the China Banking Regulatory Commission, could be implementing some more stringent rules from today. So we'll be watching what's happening in China very carefully, and of course that's having a massive impact in terms of the material sector on the Australian share market. In fact, just having a look at trade today, there's 39 stocks that make up the material sector, and only one of those stocks actually managed a gain today, and that was Incitec Pivot, which managed a gain of 1%.
Longer term, I mean, do you think the argument for being in these stocks is there? And I know, again, it comes down to view on China and view on both the supply and demand balance, if you like, for iron ore. And are you bullish in regards to that? Because that's what a lot of people in the market are asking themselves at the moment. Longer term, is this a good place to be or not?
Look, it's very difficult to be bullish on the sector because it's so dependent on Chinese growth. And really what we've seen from China is that we saw a peak. We've already seen a peak in growth at 12%. Now we're seeing growth rates of about 7.3%. So you're adjusting from growth of 12% to 7.3%. And although China's growing at larger dollar amounts, the market, when readjusting for those growth rates, unfortunately readjusts in a negative sense. I think the sector is actually changing. So instead of being more of a growth-related sector, what you're probably going to be looking at is strong cash flows, so that they're the companies like Rio Tinto, BHP, BC Iron, and stronger dividends coming through. So traditionally this was a very low-yielding sector, but I think you're going to see a shift in this sector from being very much growth-focused to being more dividend and yield-focused, and we are starting to see the signs of that with the massive cost-cutting programs, the asset divestment programs in some of the loss-making industries, as well as non-core assets, and also shareholder expectations for more things like share buybacks as well as dividends.
All right, fantastic.